Applicant staff, uh, co-coordinator of the National AAI Income and Cash Flow SIG meeting, along with Gene Trifon. And our webmaster, John Wong, is here today, as well as our two speakers, Gilbert Ho, who, as has become tradition at these meetings, will be presenting his presentation on the current outlook for the markets and the economy. And then we will introduce our main speaker for today, who is Cynthia McLaughlin of AAI National. We'll be addressing the subject of where to find the best yields in active bond mutual funds and ETFs. I want to let everybody know that we have a format where we encourage everyone, if they have questions, to enter them in the Q&A section, not the chat section, but instead the Q&A section, where everyone and then what we'll do is I'll monitor those questions during the two presentations today, and then we'll figure out the appropriate times to pose the questions to the our two speakers today. And want to let everyone know that we will also going to be we're recording this meeting, and the recording of this will show up on our page on YouTube that we have. And we're actually we do double duty here because that John Wong and I are both, as well as Eugene Trifon, we're all members of the Portland PDX local AI chapter, in addition to being the co-coordinators for the Income and Cash Flow National SIG Group meetings. So, so you'll find them, I believe, John, that's going to be under the Portland PDX label on YouTube. Is that correct?
That's correct.
Okay. So we'll have them there. And again, you'll get an email prompt when those are ready to go, when we've got those meeting notes posted. And we here at our monthly meetings that we do online here, and these are online meetings only. We do these normally on the third Thursday of each month, as we are this month. And the next meeting that we have scheduled at this point is Thursday, March 20th at the same time, and we'll have more information posted in terms of topic and speaker for that meeting in the coming weeks. But if everyone wants to pencil that in on the calendar, of course, we'll encourage them to attend those meetings as well. Again, we do these meetings on a monthly basis. So, want to just briefly do intro here for our speakers today, and I that our first speaker, Gilbert Ho, is a lifetime member of AAII and of the AI Silicon Valley chapter, where he makes his home, and he also participates in the Silicon Valley computerized investing SIG group there. Gilbert is a retired software engineer with with development and management experience at various startups and large companies. He's passionate in learning macroeconomic and investing strategies, and that included him talking about annuities during one of our most recent presentations. So, and educationally, Gilbert's got a robust background. He has an MS in computer science and a Bachelor of Science in electrical engineering. So, at this point in time, Gilbert, I'd like to turn the microphone over to you. And if you want to take control of the screen and go ahead and initiate your presentation. Again, encourage everyone as soon as you have a question in mind, if you do, please enter it in the Q&A section, and then we'll make sure that those questions get responded to during a portion of the presentation. So take it away, Gilbert. Okay. I can see the first page of the presentation on the screen. And Gilbert, I'll let you do the intro on the normal disclaimers that we offer during our presentations. Gilbert, are you speaking? Oh, okay. Now I see your audio kicking in.
Sorry. Yeah, I'm
Okay.
talking to myself.
Okay.
Yes.
I do that as well. No problem. Yeah.
So all the material presented here are for educational and entertainment purpose, not selling any product. Also, just want to say that economic and markets are not, they don't have physical, they're not having any physical laws, so they don't behave the same every time. And what you see in the chart may be deceiving. So we had a FOMC meeting end of January. Basically, there's no rate change, but the quantitative tightening is continue as they have been. Some of the key points from the meeting, and the minutes was released yesterday. So the basically economy is strong. They can't be sure inflation has stalled. So basically they are in the wait and see mode. Chairman Powell in his press conference expressed that again. So if you look at the second bullet, basically saying we cannot know if the inflation is going down. So, and you'll see in the inflation diagram later that in the last 3 or 4 months, the inflation number has been trending up. And this is why they are not doing anything with the rate. So looking at interest rate, the first chart is the difference between the long-term rate and short-term rate, which used to be very reliably indicating the coming recessions. And it didn't work this time, just like a lot of other indicators. However, we're back to normal. We're back to a normal curve.
So we no longer have an inversion, is what you're saying, and we did for a while there. Looked like
Right.
that crossed over in. I'm trying to read the. My screen's kind of small. What was the date that the inversion was disappeared on us, Gilbert?
I believe that was the end of last year.
Okay. Okay.
Sorry, maybe I'll put an exact date here next time.
Well,
but,
that's fine. I was just, I know it was talked about a lot, but in the fact that we
right.
no longer have an inversion, maybe one reason why we're not hearing much prediction of recessions in the
Correct.
near
Yeah.
future anyway.
Yeah, I think one of the reasons, my guess is why people are so conscientious about this invert is in 2007, it inverted a year before the 2008 disaster. So people gave this a lot of credit, but didn't work this time, like a lot of market indicators. The next one is the 2-year Treasury versus the effective Fed fund rate. And as you can see that generally the blue line is what the market thinks, which is represented by 2-year Treasury. That's what they think the Fed fund rate should be. And so prior to 2023, Fed is catching up. And now they're about the same. That's why another reason market is not upset when Fed is not moving, because that's exactly what they think the rate should be. This is the yield curve from 1 month to 30-year. As you can see, the yellow line is at the end of 2021. We have a normal curve. And the red line is now that this is a shallow normal curve. But on the low end, like 3 months, that is a short end, that's reflecting the federal monetary policy. And on the long end, over 10 years, that is usually the inflation expectation or maybe also budget deficit. Here's the quantitative tightening. The blue line is the Federal Reserve balance sheet, and as you can see, we went from million, which I guess is trillion, from 9 trillion to right now 6.8-ish. But M2 money supply, which people say money supply drives inflation, and looks like M2 is starting to trending up. So we'll see. Okay, the job opening at the beginning of the month, the data showed that this is showing the number of unemployed per job opening. So anything under 1 means we have more jobs opening than people needing jobs. And we've been there for a while, since mid 2021. The blue line, the purple or blue line is the job opening number. As you can see, we are on a downtrend, and now we are a little bit flat recently. The green line is the hirings, and the rate of hiring is coming down, but the red line, the total separations, the people losing job, leaving job, are also, percentage change is also coming down. Another number to look is this orange quits rate. Having these rate back to 10 years ago level, indicating the job market is not hot and maybe heading toward cold. In terms of employment, yes, go ahead.
Let me stop you for a second. With the layoffs going through, with the government restructuring, with the Doge effort right now, should we expect an increase in the quit ratio? Will those government layoffs be reflected in those results in the coming months?
I'm not sure it shows up in quits. I'm pretty sure it shows in the red, which is total separations. Total separation means anything, any reason. You got laid off.
Okay, right.
Yeah,
Okay.
yeah,
Good
you got
point, good
fired or
point.
anything. I recently heard like the total number of firings is not a huge percentage. It's a big news, but not a percentage-wise, it's not a huge. Also, there is a comparison. The Doge is using the 1993 Clinton, government efficiency drive as a predecessor. And the numbers there is much higher, although it doesn't seem like people remember that. So I guess
Are you saying that the restructuring that occurred during the Clinton
yeah.
presidency were larger than what we're seeing with Doge? At least on
I believe that if I remember correctly, the people that were impacted is about 200,000. That may or may not be higher than what they're doing now.
Gotcha. Okay,
Yeah,
thank you.
sure. I might want to add that during the Clinton era, they did 6-month study and took 3 years to implement. This time it all happened in a month. So that's the impact. In terms of initial claim, this is a 2-year chart. As you can see that we are pretty much flat. And if you zoom out, which I don't have a chart, this is really low. We are at this historical low level here. So the job market at this point is healthy. The unemployment rate and labor participation rate, these were released at the beginning of the month, and it shows that we're about flat. And in terms of income, average income, and inflation rate, so far the income increase rate is higher than the inflation rate. This is the total number of private employees, non-farm private employees. Generally speaking, we're quite off the 2021 pace. This is for the Silicon Valley, the unemployment rate in the 3 counties. And well, sorry, three cities, and we're about flat too. Okay, so one of the important thing here is US dollar. For the last 35 years, we are about the high end of that range. And there's a lot of things here, but the last bullet just says the tariff usually favor favor the dollar. Commodity futures, gasoline has been sort of flat. This is for the last 12 months. So the natural gas was going up because of the weather, and the copper is in the middle range. Copper usually reflect industry production, stuff like that. Corn is trending up, and cattle, which is beef, is also making new highs. And lumber is on the high end of the range as well. So you can see that there are inflation pressures. So talking about inflation, the one thing to look is the PPI, and it has been trending up slightly. And the actual inflation rate, the red is the CPI, which is what everyday people look, and the blue is the PCE core, which is what the Fed look, the monetary policy people look. And you can see both are trending up in the past 4 months. We will have a new number for the PCE at the February 28th, which is another 8 days.
Mm-hmm.
Yeah, and then I just look at China's PPI to see if there's any pressure there. It looks like it's stable, and this is what the Fed chairman mentioned. A gauge they look at it, which is the supply chain pressure index, and you can see that other than 2022, 2021, we are back to normal again.
Well, it'll be interesting to see with the tariffs that are taking place and being phased in some cases maybe longer term, in some cases maybe, negotiating tools by the Trump administration, that we're going to, how those numbers are going to filter through to the inflation indicators. So I'm going to guess that investment strategists or economic strategists are going to be watching these inflation numbers more closely than they probably even normally do because of those trends.
Yeah, that's certainly is a big unknown. Okay, so some of the purchase manager index, which used to tell us if a recession is coming, and so the manufacturing PMI had finally the red line is 50, and so above is expansion, below is contraction. So manufacturing has been contracting for the last 2 years, and finally it's about 50. But manufacturing only is a small portion of the whole GDP. So the more important one to look at is the service PMI. And as we can see that the service PMI is generally in above 50, which is in expansion territory. Again, this is another indicator where Fed Chairman Powell mentioned they are looking at, and as we can see, this is based on GDP, and as we can see that there was a big spike in 2021, 2022, but we're back to the pretty much historical norm. The Atlantic Fed's GDP now forecasting the Q1 GDP. Currently, they were saying 2.3%, which is middle of the road, I guess.
Well, the Fed's target is 2%, right? So it's not that
oh no,
far
that's
away.
inflation. That's inflation rate. This is
Oh, I'm sorry. I'm sorry.
Right.
I apologize.
Yeah.
Apologize.
Yeah. So this is GDP stuff. Yeah. Okay. So every quarter, New York Fed, I believe, Federal Reserve Bank of New York, publish these numbers. So the first one is total debt balance and the composition. As we can see, that 70% of it is um, mortgage, and a lot of people are sitting on low rate there. And then the rest of them are composed of the other loans. I was surprised to see the student loan was the next biggest percent. So the total balance, the delinquency status, I look at this and I draw this line to say this is the level we were at 2005 and 2006. And right now we are still below it. So I guess we could say that by historical standard, this is not, there's no issue here yet. This is looking at transition to delinquency 30-day plus. So, apparently delinquency has 30-day, 90-day, 120-day, or very severely. This is just 30 days. And as you can see that student loan, I guess because some of the Biden efforts that the delinquency rate is had a sharp drop. But almost everything else is trending up. Now, looking at new foreclosure and bankruptcies, as again, I draw this line here to say that these, before 2000, that would be a good level, and we're even below that in the recent years. So no red flag here, I guess. And finally, this leading economic indicator is used to be really reliable to tell you inflation is coming, and it didn't work in 2023, and now it's saying we're healthy again. So we'll continue to monitor this to see if it works next time. And that's all I have. Thanks. Back to you, Todd.
Thank you, Gilbert. We had a couple of questions here. And one is, can you speculate on how the foreign policy changes, and I assume that probably incorporates the tariffs. That's are my comments portion of it will affect it. But the questioner is asking, how will those affect the dollar supply chain and specifically produce production? They're probably wondering how that might filter into food prices, food price trends. Any ideas there?
I like the word speculate. I am speculating. I'm no expert, but the two things that came to my mind, one is I just saw news about farmers complaining they're losing subsidies because farmers getting a lot of subsidies from the government. But somebody also said Trump won. He did the tariff with China, and so China doesn't buy our agricultural product anymore, and the farmers suffer a lot. So he actually has to give farmers extra subsidy to make them happy. So that's one thing. The other one is a lot of produce come from South America, and he's raising the tariff issue there. But I think that's more a negotiation than actually you want to charge tariff there. I think any politician, they need to make people happy, and Trump was elected partly on inflation problem. So I think they'll keep that in mind, considering in less than 2 years, there'll be a midterm election, and that will show the scorecard, and they would have to work on that too. So that's my answer, my speculation.
Gotcha. Somebody asked Gilbert if you can turn your camera on while you're answering questions.
I haven't shaved, so.
Oh, okay. Well, we can get away with that. And another question was, and I guess you alluded to that a little bit. What are the effects of tariffs on imports? Considering the economy is not really I mean, it's relatively strong, but not boiling over. So, should those tariffs have as much of an impact when the economies not around the world are not growing at that robust of a rate?
Um, yeah, my personal speculation is tariff is going to be a negotiation tool, and
Hmm.
um, I think Trump is trying to make sure no one take advantage of that or do dumping on us, and he also wanted a lot of stuff to be made in America. Um, so if as long as he adhere to those principles, that seems like it should benefit America. I don't know what's going to happen, and I don't know what they really think, but that's what I would hope for.
Gotcha. And so, and you said earlier you thought that prior to the Trump administration, that China was buying more of our food exports from the U.S. to China, and not as I haven't really tracked those trends, but not much of that is going on in the
No, what
past.
I
Is that?
said, no, what I said was I forgot it's 2017 or 2018. There was a tariff going on with China, so China stopped buying our agricultural product. So a lot of farmers suffered because prior to that, China increased their demand, so encouraged a lot of farmers to grow stuff for them. And then when they suddenly stopped, those farmers are in deep yogurt. So Trump actually had to provide government subsidy for them, so uh, they won't be too upset. That's what
Got
my understanding.
Okay,
Yeah,
okay. So that was during the first Trump administration, right?
exactly,
Right. Okay.
exactly.
Okay. Well, appreciate that. So, well, I think we've answered all the questions that have appeared in the. Oh, here's another one. I missed a couple. One question was for basically saying for corporations, it could take 3 to 5 years to retool manufacturing plants. Meanwhile, there's a lag effect between, because it's one thing to say, well, we want more manufacturing here as opposed to overseas, but you can't do that overnight. It's a major factor. And the question you're saying, well, it could take 3 to 5 years to do that. And so they're implying that, well, meanwhile, tariff prices will be enacted, consumer prices will rise because we can't retool quickly enough to manufacture here, if the exports of those products cease or reduce significantly because of the tariffs making them less competitive, I guess. So,
I think if I'm optimistic, I would say take the auto industry, for example. Uh, a lot of the Japanese auto industry was pretty dominant in the 70s, even early 80s.
hmm.
And if you look at what happened after, I don't know if tariff was the main reason, but now they all had factory in the US and making cars here, right?
Right.
Mostly in the southern states. So I hope that is the end result is we quote encourage a lot of foreign manufacturers to set up factory here. So they will be made in America. And that's my hope.
Okay. Um, Another question that we had, Gilbert, that came in, wondering if you could comment on with views of the growing budget deficit and impact on that could have on 10-year treasuries, and that's something actually we'll also ask our main speaker Cynthia McLaughlin to comment on too. But so that how much of a factor that might be in working through and impacting the bond markets, with assuming the deficits grow because of policies that are being enacted now, including the tariffs. So,
Yeah, that is a really good question, and I'm very sure nobody knows all the factors that impact Treasury interest rate, the long-term ones.
hmm.
My slide says mainly was inflation expectation, but I think the best thing, unfortunately, the best thing to look at is in the longer term trend, more than 6 months than looking at in the short term. Because the bond market, there used to be a saying like the people in the bond market is smarter than people in the stock market. And but there's a lot of reasons for to impact the interest rate. And um, I'm sort of in the camp that the federal deficit is not a main factor at this moment for the interest for the 10-year trade rate. It, it is something else, and I don't know what it is. And also, with the new administration conscientious about keeping the deficit low, or at least they say that, that shouldn't be a problem in the near future. So we shall see. I'm sorry, I really don't have answers.
Well, that's not an easy question to answer. There are a variety of factors, and you know they may come down for other factors in the short term, but longer term, the deficit is probably more of a significant factor. So. Well, I'd like to, I think that's going to wrap up Gilbert's portion of the meeting today. Thank you very much, Gilbert, as always, for your preparation and analysis, as well as responding to those questions. And so at this point in time, we'd like to transition to our main speaker for the day, and that is Cynthia McLaughlin. And who I believe just turned on her camera. And I'm going to, we're very fortunate to have Cynthia here. She's an investment editor at AAI National. So her articles, including one appeared in the most recent AAI monthly publication, which I just read the other day. She's the lead editor of Retirement Investing and also the VMQ premium product for AAII and contributes regularly to the AI Journal. Her experience includes roles where she wrote and edited content focused on investment products, asset classes, retirement planning, and she's got experience creating leading award-winning financial education marketing programs. And she's got also has experience in the telecommunications and software industries, where she held products and project management positions. She started a career as a programmer analyst, so always having technical skills and analysis. It's a bachelor degree in math and computer science, and an MBA in finance. And she's an active member of the CFA Society in Chicago, where she makes her home, as well as Indianapolis. And like to, and we're very fortunate. I thought it was an opportune time to talk about the outlook for fixed income and the various fixed income products for the where to find the best yields in active bond mutual funds and ETFs. So Cynthia is going to talk about that today, and so we'll turn the microphone over to Cynthia. Welcome, Cynthia, and thank you for being here today to present to us.
Oh, thank you, Todd, so much for inviting me. It's a pleasure to be here, and I'm really excited to be a panelist tonight. For those of you who don't know me, and by way of introduction, just a little bit about myself. I live actually in the Indianapolis area with my husband and my Great Pyrenees. I've been at AAII for almost 2 years now, and I like to go running, and I belong to a running club here in the area. So, enough about me. I am going to share my screen. So, Todd, you can be my guide and tell me if everything looks okay to you.
Okay, let me take a look at that. And I also had mentioned, yes, I can see your presentation screen here. And I also
Um,
would mention to all of our attendees that just as you did for Gilbert's presentation, if you have any questions along the way during Cynthia's presentation, please feel free, and we encourage you to enter them in the Q&A section, not the chat section, but the Q&A section of the presentation. And and we'll seek to get to those questions sometimes during the presentation, probably on the latter end, because Cynthia's got a lot of material to get through today, and we want to make sure that we're getting through all the material that she has to share with us before getting into most of the Q&A. But please enter the questions as soon as you think of them so we can respond to them later on in the presentation. Thank you, Cynthia. Go ahead.
Oh, thank you. Thank you in advance for your questions. Okay. So tonight I want to talk a little bit about the fixed income landscape. What I'm going to talk about is kind of a bird's eye view of some of the things that Gilbert adeptly covered, and talk about the case for active fixed income. Just take a peek at some sample yields across select asset classes per the ETF and mutual fund screeners in our AAII tool box. And then I'm going to talk about active fixed income, mutual fund, and ETF categories, and then the choices within those categories. And then we're going to peruse over to the AAII website, where I'm going to do a little demo for you about the member resources. So you can go off and figure out what active fixed income mutual funds and ETFs are of interest and helpful in your portfolios. Okay, so going into the fixed income landscape. So right now, as Gilbert was talking a lot about, we have some mixed signals with rising government yields and narrowing corporate spreads. So the government bond yields, we have some of these financial fiscal burdens, uncertainty in the inflation outlook and the monetary policy. And then in contrast, we have corporate bond spreads that are narrowing. So that's reflecting investor confidence in some of the corporate balance sheets. A lot of my portfolio holdings for VMQ are saying, you know, hey, I'm working on getting rid of debt. My balance sheets are becoming stronger. That's a goal that I'm frequently seeing in some of the stocks that I'm pretty familiar with on a daily basis. So we do have some economic fluctuation and uncertainty. And January CPI, I believe I read this in Barron's, it was 3%, the highest reading in probably the past 7 months. And we've talked a little bit about the trade policies and the potential to disrupt supply chain and elevate production costs. I think Walmart got nailed after announcing pretty good earnings, just indicating, yeah, we get a lot of stuff from abroad and things could get more expensive for our customers. So those things further complicate the inflation outlook and also influence fixed income investments. And just looking at the CME Fed Watch tool, this kind of confirms that the Fed is indicating, yeah, we're going to be steady Eddie, maybe a couple of small rate decreases, but nothing drastic on tap. So a lot of this really leans into the case for active fixed income. So the fixed income markets, we know they're fragmented, and we know that active managers like to jump in and exploit price dislocations and all of these market shifts, index replication challenges. Those present targeted opportunities and benefit active managers. So I just wanted to talk a little bit about why this topic interested me, kind of going behind the scenes with the AAII journal. We meet every month as a team, and kind of suggest topics for all of the upcoming columns. And you're supposed to come prepared with your ideas. And one of my ideas was, well, what about examining, really looking into active fixed income mutual funds and ETFs? I listen to a lot of podcasts, and I keep hearing about there are more and more ETFs being launched in this area. It's kind of the last frontier in ETFs. If you follow the ETF industry, you know, like there's an ETF for everything. It's there are some really interesting but very complex ETFs out there. Another thing I noticed is that over the past few years, in 2023, the fixed income active ETF went from 33 billion. Then last year it was 100 billion. And I just read earlier today that now, as of like the end of last week, there are already 25 billion in flows coming into active fixed income ETFs. So it just proves that this area is really growing, and all of these periods of elevated volatility are going to give active managers an opportunity to use these instruments and mutual funds to create income and alpha for their clients while they're trying to kind of mitigate some of these uncertainty and these policy risks that we've talked about. Okay. So and some of these things I've touched on a little bit before, but what these managers are trying to take advantage of flexibility and changing markets so they can go in and adjust portfolios in response to interest rate movements or credit changes or predicted economic shifts. And they can use them for enhanced risk management. So unlike a passive strategy, active funds really you can kind of manage around weaker bonds or in just bonds that you want to introduce to reduce duration risk. And that will allow you to manage, credit exposure more effectively. And then they have the potential for outperformance, as does all active management. Yep, you're probably laughing and saying, oh, but index funds usually do better. But in more volatile environments, people probably might tend to lean to active management. So the skilled managers can really jump in and take advantage of some of these dislocations. And then diversification benefits. Active bond funds can access a broader range of securities, kind of off the bench opportunities. They might look into structured credit or emerging market debt. And then index replication. So when you're setting up an index, a lot of the fixed income securities that are in an index, sometimes those have to be replicated because they just don't trade as often, or a lot of ETF managers or mutual fund managers will use a service to kind of estimate prices. So this may help get around some of those issues. Okay, so now that we've just set up the case and the landscape for active fixed income with ETFs and mutual funds, I wanted to share some sample yields across asset classes. So I like to spend a lot of time in our AAII mutual fund and ETF screeners. And last week, or actually earlier this week, I went in and just created a couple of screens to kind of filter and provide some information on dividend yield, because I know everybody likes to think about yield and what yield can do for you in terms of fixed income. So I went in and created screens just using the criteria that you can see to the left, and looked at US equity, dividend, and income. And I looked at corporate bonds, high yield bonds, and real estate and MLPs. So this will just give you a little bit of a flavor, kind of going up the food chain. Probably high yield has the best yields, as of course we would expect, and then corporate bonds, MLPs, real estate, and then dividend is a little bit on the low end compared to those other asset classes, but not as risky. Okay, so moving on to the categories, and I know Todd wanted to really have me talk about this. This is a screenshot from the ETF screener, and it just gives you, if you go and filter on the asset class type, you're going to get a myriad of fixed income securities. So under global asset class, these are all of the filters, that all of the types of securities that it brought back. And this is what I used, the filter I used to create the screens shown in the article that we're talking about. And what I did for expense ratios, so we want low expense ratios, and we want those to kind of be low in their category. So for ETFs, that is between 0 and 80%. I'll kind of compare and contrast that to mutual funds when we get to that slide in a minute, but that allows us to kind of fence those in and look at those with low expense ratios. And then the 5-year return category rank. So I only wanted those funds that, or those ETFs that were in the 41 to 100%. So that provided us with higher performing. And then we want ETFs that trade. So the minimum trading volume, I specified greater than 5,000, and then I set the index fund to false. So it will bring back all of the active ETFs that do not track an index. So this will make sense a little more in a minute when we go over and have a bit of a look and see on the website. So currently, this brought back or provided ETFs that with yields between 3.2% and 8.2%, and then expense ratios of 0.08 to 0.6. And you may be thinking, well, gosh, 0.6 or 0.08, that's probably not real great for an ETF, especially if you're familiar with some of the Vanguard or iShares ETFs, which have, really low rock bottom expense ratios. But keep in mind, these are actively managed, so the expense ratios are going to be just a little bit higher. And then the portfolio turnover ratios. I think it's important just to see, how much these portfolios are turning over, how much is that active manager engaging and changing things up. 367% to 0. So the largest turnover ratio was in the intermediate core plus ETF and the smallest in an ultra short taxable ETF. So one thing that I really like about the screeners is the ability to kind of pull the data out and then wrangle it and just, look at what story it's telling. Okay. And then for mutual funds, I did something very similar. With mutual funds, you actually have to give the screeners more criteria because what you're trying to do is you're trying to exclude some of these share classes that individual investors, such as yourselves and myself, some of those share classes that we can't invest in, or, even if we could, we probably wouldn't want to because they have a low minimum investment of, like it starts at $1 million or whatever. So I remove all of those share classes, and usually I will set the minimum investment amount, the minimum to 50,000. So that is kind of the ceiling. It will not bring back or show me any ETFs or I'm sorry, mutual funds that have an investment ceiling above 50,000. And then you may be wondering, what is this inverse or leveraged? So there are mutual funds and ETFs that are either these leveraged to get their returns, or they have a strategy that provides inverse returns. Like if the market goes, they're structured so if the market goes down, you get better returns, or the strategies are usually complicated, a little risky, and so we filtered those out. But you're welcome to look at them if, of course. And for the mutual funds, the yields ranged 2.3 to 14.3, and the expense ratios were just a little bit higher, but there were a few funds that came back with no expense ratios. And then the portfolio turnover, non-traditional bond funds had the largest portfolio turnover, and then a long municipal bond fund, smallest, as you might expect. Something
Uh,
like that's going to be a little more stable.
Cynthia, if I
Okay.
could just interject, you were comparing the expense ratios on mutual funds, saying they're a bit higher than the ETFs. Is that what you were comparing them to?
Yes.
Okay, great. Thank you.
Yes. Yes. A little bit higher than the ETFs, but also actively managed. They're in line for what you might expect.
Thank you.
Okay. So I wanted at this time to go over and take a look at the website, but I just wanted to let you know that I put together some screenshots of member resources. So this can be more of a takeaway. It's not really interesting to go through these in slide format, but I wanted to have them here just as a backup in case something technologically unfortunate happened, and for you to have them as a handout. And then I wanted to call to your attention the journal articles that we have that are focused on fixed income. This is a link to the article we're talking about tonight, from January, from last month. And we also have an article about defined maturity bonds. Those are the bonds that Invesco and iShares have. And then we have the article from September where we just, I looked at all of the high yielding mutual funds and ETFs, ones that offered like options, like JEPI, and just I'm trying to break down the yield and what type of reward and risk profile those had. So that might be some interesting reading if you're up for it. Okay, so Todd, I stopped sharing and then I'm going to go ahead and share again, this time sharing my screen. Okay, how does this look? Can you see my screen?
Yes, I can see the screen that has the AI logo and from the website it appears.
Okay, great, thank you. Thanks for being my second set of eyes. Okay, so this is the AAII homepage, and under ETFs and mutual funds, we have resources that are available for all members. So one thing you can do, I'll start with mutual funds. Okay. You can go in here and take a look at the top and bottom performing funds. You can toggle between top funds, bottom funds. You can look at no loads. That's obviously a very important thing. I forgot to mention that when I was on that slide earlier, but we always look for funds that are no load. If you know a particular fund family you're interested in, you can select that. And then you can look at these different asset classes, these different types of funds for categories. And you can look at different time frames also. So this will, I just switched from 5 year to 1 year. It's going to show me the annualized return. It's going to show me the category. It's going to show me the category risk, or how a particular fund, how risky it is compared to other mutual funds in that same category, and the all-important expense ratio. And then we have the AAII grades. So this kind of gives you a little snapshot of things that are also available in the ETF and mutual fund screeners. And another really good thing you could do, you can look at the guide to mutual funds and ETFs for 2025. Can go in and look at, okay, this will show you the fund categories, and given the group, the and a little more return information, and then how everything has done, and or how it is working per global asset class. So obviously a lot of information that you can work through and absorb. So one thing that is helpful is if you have a couple of funds you're interested in that you want to take a look at, if you know the tickers, you can type them in this little bar. So I'm going to select a couple of funds from the US equity large blend category, just something I know off the top of my head. And I will get a screen of information. It's going to tell me the name and what category it's in, and it's going to give you this information in a nice little succinct table, and it's going to also tell you, is it closed to new investors? So obviously we don't want to try to invest in something that is already closed, but it's going to have information for, the 1 month, 3 month, year to date, 1, 3, and 5 year, kind of that short term and long term, so you can see how it has done over those time frames. If it's not available, I think it just pretty much leaves it blank. That's a little more of a situation with newly launched ETFs than I see with mutual funds. Okay. And then going over to the ETFs. So, oh, just these are next to each other, and just click on them through the pull down. Again, toggle between top and bottom. If you know a family or provider, and then looking at the different types and the time frame. Okay. So again, that's something available to all subscribers, and they compare ETFs, SPY and VU. VU just overtook SPY with assets, so it's kind of a fun one to look at. And again, complete information, just a little different because ETFs versus mutual funds. Okay, so moving on to the screeners. And these screeners have been available for a long time. We relaunched them late last year, and we continue to make improvements. I'm always trying to sneak in new features or something different with our IT team. So definitely this is something we're really excited about, and it's available to A plus and subscribers in those types of memberships. But basically, you're going to add filters, the global asset class, and you can select the 5 year category rank, and you can go down and select, I always select leverage, inverse, index fund. This is where you would tell it active, or if you don't select it, it will bring back both active and index funds. It will just bring back everything. No load. I'm going to select the share class, the highest minimum purchase, and going to say not close to new investors. Okay. Going to hit apply. And if I forgot anything, I can always go back and say add a filter, or I can reset if I completely want to do something new. I can save these and pull them up again. Well, we'll try the fixed income. Okay, the 5 year category rank, 41 to 100, no inverse, funds, no leverage, and we do not want any index. Okay. And then 40 to 100, and you can just play around with these as you get output from the screener. True no load. Yes, I want all no load. And close to new investors. Nope. And then I want to tell it less than 50,000. And then no institutional funds. And here is where I'm going to get rid of all of the share classes that are not of interest to individual investors. Or they could be. You can leave that in there. Okay. And over here, I think it's really helpful that it saves your query. So if you need to, you can take a screenshot of that and then you tell it to find the funds, and it's going to provide you with a lot of output. So you have overview information, performance information, risk. I talked about the category risk. We also have the total risk, standard deviation, alpha, and then portfolio statistics, which I'm going to limit this to 10 per page. We have yield, and that's important for fixed income, obviously. And it's going to tell you is it an index fund? So no, we selected no. And then this is where you're going to see all of your fee information and what type of other fees for mutual funds it may have, and the share class, and then other fund information. Somewhere in here is the tax cost ratio. That is a good one to examine, and it is something that I included in the article.
Right, Cynthia, if I could interject, I think, because what you have done uh, is you've got a printout schematic in that article that shows the top performing funds in the
Yes.
various categories. So, if for those members that don't want to do the screening process yourselves,
Mm-hmm.
Cynthia has done it for you in the latest AAI journal edition. So keep that in mind, and all members have access to the journal. So you can look online, or if you get a copy in the mail, depending on how you received it, you can consult that article to see the results of which I guess you're showing us right now. So,
Yes, that's correct, Todd. So if you go into that journal article and you look at Table 1. So Table 1 is an export of all of that criteria. And then I further wrangled the Excel spreadsheet to include further information, the return information, the yield, expense, tax cost, and um, then we have our AAII grades. And this was also done. I'd like to give just a ton of credit to our editorial team and our designer Annie for putting together all of these tables every month. And then this is the ETF table. Okay. Well, could you see that? First of all, I kind of jumped over there without confirming, but okay. And another thing I want to point out in the screener is that you can, if you type in a particular ticker in the search bar. Let's see. Just gonna pick one. And I type search. It is going to highlight that particular fund. And if I click on the ticker, it's going to take me to the fund evaluator. And what is so great about the fund evaluator, it has things in here about category averages, and it has a plethora of information. And if you go down here, towards the end, you can also look at the portfolio allocation. It's not as granular as if you go to the fact card on an issuer's website, but it will give you a really, really good idea. It kind of gives you that first approximation. Okay. And then also, we have help. There is how to. Again, this is kind of a team effort. I worked with editorial, and they came up with a lot of the nuances that are presented in this how to. So I'll just go over to the ETF screener, kind of show you some differences. So you have the global asset class, and then I talked about the average daily trading volume since ETFs trade on exchanges. And this is the criteria that you would select if you want to go ahead and try to find ETFs that are frequently traded, as opposed to just not having, that stale NAV because they aren't trading as often. And then you have the same type of criteria with the NAV. You can also look at price returns within a category, something not available in the mutual funds. And you can filter for inverse, and the expense category rank. But overall, there are not quite as many fields to select from. And within ETFs, and say municipal and taxable. Greater than 5K. Yep. Return 41 to 100, no inverse or leverage, and then expense ratio. I think I selected 0 to 80 for the article just to get a wider universe. Okay.
Cynthia, I want to mention to you, we have quite a few questions in our queue for the
Okay.
Q&A portion when you're ready to take those.
Okay. Great. Great. Thank you. Okay. So I think that about wraps up the presentation that I had prepared. Go ahead and
Okay.
stop sharing my screen. Todd, did you have anything you wanted to add before we moved on?
No, I think this would just be a good time to go to the Q&A section. And if I can I'll just go through them and you can respond to them if we could. And historically, one viewer said, how have active fixed income funds performed relative to index funds?
Oh, that's a great question. It kind of depends on the fund. And it kind of depends on the time frame also. So I really don't have a lot of specifics on that, but you can certainly take a look and use the screener to further evaluate. There are just so many different types of sectors available
Well, it's interesting. I should
to
interject. I
look
just
at.
went to a presentation at an investment conference where they discussed this very issue, and they were comparing how active fixed income managers do to their benchmarks in aggregate relative to active equity managers. And there's a much higher percentage of fixed income managers who outperform their benchmark. In fact, most of them
That's
do
great.
relative to, so that's much better than equities, which is another reason for Cynthia talking about and structuring this article about discussing that, because it is pretty broad and consistent. And you're right, Cynthia, that there's a relatively short history on a lot of these funds because there's so many new ETFs, and most of the funds that are rolling out these days are ETFs and not mutual funds, so that changes the landscape too. So but it's something for fixed income managers active fixed income managers, they can hang their hats on, relative to most equity managers. So. Um, uh,
Yeah.
they also, another questioner asked, I'm just going to run through these other questions. When would you recommend using a mutual fund versus an ETF where both exist and they have similar investment approaches? Would it be just predominantly an expense ratio decision, or?
I am going to say it would with me personally, it would predominantly be the expense ratio. And I'd also take a look at the holdings just as I always like to go through and look at what the holdings predominantly are, and also, how often are they turning over the portfolio. I think it's important sometimes when I'm writing these articles and I go and look at that scenario, there are a lot of very interesting things included in these mutual funds and ETFs that one wouldn't expect. But especially for something that's more plain vanilla, if it tracks the ag, I'd probably go with an ETF just to keep a lid on the expenses.
Thank you. Let's see. Another question was, does uh, one questioner wants to know, does the fund screener show is up to 10 years performance histories?
Yes, it does. That will be dependent on if the mutual fund or ETF has that track record. When you do the output, it will say NA for funds that do not have like a 10-year or 5-year performance. And when you are reading our articles, we always have kind of that dash that we insert, and some of the ratios require that we have, or that the fund or mutual fund or ETF has a 3-year history. So just a little bit of detail on that.
Okay, thank you. Another question is, do and this gets into sophisticated bond analytics, this particular question, does the ETF or mutual fund databases show convexity curves? In other words,
Oh,
how much, how a bond fund will react to changing interest rate trends,
that's
or
right.
perhaps some other risk rating factor to take those into account?
Oh, that's a great question. I don't think that it gets in. I have not seen that as an output,
Okay.
but that would be an interesting thing to look at.
Yeah, I agree with you. I'm not sure I've seen it either, and but it could be interesting to uh, to review that. And it's going to change over time depending on the slope of the yield curve and a variety of factors. Um, okay, let's see. Do we have? Um, do you? one question is, does shorter term bonds have a place for investors with a longer term investment horizon? Should investors consider having short term bonds as a component of their bond portfolio and their total investment portfolio if they're longer term focused in nature?
I would vote yes, just because of the purposes of diversification and just seeing what has happened over the past few years where in that kind of shorter portion of the yield curve had some really good returns. But that's a really good question.
Yeah, I think, and it could also add, it could depend on whether you've got an inverted yield curve, whereas Gilbert
Yeah.
talked about, we did until fairly recently, and that can impact where you can might be able to lock in a higher rate of return on the short end of the curve versus longer term, and depending on, and but then when you've got a positively sloping yield curve, as you do in most of the bond markets now, that's a different situation too, where you're paid to take on more duration risk. So really depends, I think, but I think it's a prudent choice myself too. I think you're right on there, Cynthia. Um, let's see. I think we had one participant say that is there a way to email this information to them? Well, what will happen is the presentation, the meeting will be posted on our YouTube channel, um, uh, i- and that's probably another week or two. And then you'll get an email out there that material is available, and that will be the YouTube channel for the Portland, Oregon Metro PDX chapter, because we kind of serve both roles for that chapter and also for the National Income and Cash Flow SIG Group meeting where we conduct most of our meetings. So, but that yes, that answer will be, or that material will be available to for viewers on the call today or those that may have missed the call at a later date. So Cynthia has authorized us to do that. So let's see. I went through the list of written questions. We've got a few minutes left. If anyone has any additional questions, you can use the raise hand um, icon on the screen, or you can type it in the Q&A section. And I also, having said that, want to remind everybody, as I cited earlier, that excellent article that Cynthia wrote that's in the current AAI journal that has the printed out results of examples of the screening that she took us through earlier in the meeting today. So you don't have to do that at home. You can review that the publication results that she's provided for you. So, so I would encourage everyone to check that out on the in the current AAI journal, which comes out monthly. And um, I think that may be it for the questions, Cynthia. So thank you very much for
Well,
presenting
thank you.
today, and really appreciated having you. And thank you, all you attendees for your participation at the meeting today. And our next meeting is likely going to be on March 20th. And again, that's the third Thursday, which is what we normally do. Oh, there's one other question. Oh, yeah, one other, excuse me, let me throw in one other last minute question that appeared in the chat here, Cynthia, and that is how to differentiate between treasury and non-treasury. And I assume that that questioner is asking for maybe comparing treasury securities to government agency securities. And that was
Mm.
the question there. Is there anything that would tilt you one way or another, Cynthia, whether to consider um, Treasury versus government agency bonds?
Well, I think the thing with treasuries, right, is they're guaranteed, by the full faith of the government, and the agency securities. I don't know. That's a good
Yeah.
question, but I think in my case, I would feel a little more comfortable with a treasury because I think the agency securities just have their objectives are a little different.
Mhm. Yeah. Yeah, and the treasuries are the most ultra secure investments,
Yeah.
and you're right. It could depend on the type of government agency security you're talking about too. So, and so by the way, Cynthia, I want to make sure that we gave you time you got through all of your presentation. You showed us everything you planned to in the presentation. Somebody was asking about that.
Yes,
Okay, great.
definitely.
Okay, appreciate that. Okay, thank you.
Definitely.
Yeah.
It's just
Thank
it was something where it was a little easier to go and do a little show and tell versus kind of work through some slides. So
right.
hopefully that was okay.
Yeah, appreciate that. Yeah, I think it was educational. And I'd like to thank Cynthia again for joining us, for Gilbert Ho for his portion of the presentation, and the
Absolutely.
support of John Wong, our able webmaster, and the other AI members. And thank you for attending today. And we'll look forward to hopefully seeing all of you on our future presentations. So, thank you very much.